Broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody, and thank you for joining us for our webinar today. My name is Andrew Paolillo. With me today is Sean Caraher, and we're excited to walk through a couple different topics that we think are certainly top of mind for depositories right now. And, when you think about what we were discussing, a couple weeks ago when we were, putting together some ideas, given the incredible volatility in the markets in the last week or two, it certainly strengthened our conviction on how relevant these topics are. And also, as a side note, for Sean and I, it's been challenging in terms of pulling data when you pull something at 10 o'clock in the morning and then you turn your head and rates are all over the map. So the plan for today is we're going to take a deep dive into three different areas. So Sean is going to talk about deposits and how we can think about pricing and growth given the brave new world we are in terms of rates and liquidity profiles. I'm going to talk about strategies for credit unions to manage exposure to the NEV test, which is certainly a hot button issue. And then lastly, we're going to talk about preparing the balance sheet for lower rates, which is a little bit of a skate where the puck is going, not where it is exercise that, I think will be worthwhile to talk about. So before we jump into those topics, two ideas to point out here, and these fall in the category of things that we're talking about with members and are relevant in the current environment. So the first one would be pledging investment securities. It's a way to liquefy underwater bond holdings. A lot of our banks and credit unions historically maybe haven't had to pledge securities because they've done a good job with their residential and commercial pledges. But again, this is a function of this unique environment that we're in. So if this is something that you've thought about or kicked around internally, reach out to your relationship manager and we'll be happy to discuss the process of pledging. And the other thing to point out is if you haven't been looking, pay attention to our short-term rates, specifically inside of 1 month, and compare it to the level of interest on reserve balances. Some interesting things happening on the pricing where, around these big rate hikes, we've seen our short-term rates be at or below where you can place the money at the Fed. So even if you're not in a net borrowing need for funding position, there may be some favorable economics, particularly when you factor in the ever-increasing dividend that helps reduce the cost of funding. And, consider this time next week, we'll be clear of month and quarter end reporting periods, still a bit out from the next Fed meeting. So there is a little bit of short-term opportunity there. So with that, I'm going to hand it over to Sean and he's going to talk about deposits.
Thanks so much, Andrew. So we're going to start actually with opening this up for a poll question. It's right now it's kind of season to think about strategic planning, and then a lot of folks are probably entering budget season as we get into the fall here in October, November. And the question is simply, what do you expect for deposit growth in 2023? Less than 0, that is negative deposit growth, 0 to 3, 3 to 6, or more than 6% deposit growth. Just going to give folks another second or two here to kind of mull that over and throw in some responses. People have had some different levels of deposit experiences, I think, in recent times. So I'm really curious to see what we get for results here. I wouldn't be surprised if we see some divergent answers across the listeners here.
Right.
How'd we do?
Okay, so let's close out the poll and see where we are at.
Can't quite see it.
So it looks like 17% of folks less than 0, 57% the largest bucket in that 0 to 3 range.
Gotcha. So that's interesting to see that those are very below trend historically. And I think it kind of shows that folks are probably wising up to the fact that there's been a couple phenomena that's been happening with deposit growth in recent months. I'm sorry, this clicker is not going for me. There we go. So this is just taking a quick look at what we've seen in recent times compared to kind of the long run history. I think a lot of folks are recognize the fact that deposit growth in the past couple of years and asset growth as a result of it has been really, really significant. And effectively what's happened is in 2020 and 2021, very beginning of 2022, we saw basically 5 years worth of growth in 2 years. This chart is comparing deposits and asset growths across our member credit unions and banks over 2 time horizons, that 2020 to early 2022 horizon, and then 2014 to 2019. So the 5 years immediately preceding this most recent sort of COVID-affected environment. And what you see here is that the compound annual growth rates, are extraordinary by any measure compared to what the history is. On banks, deposit growth of 18%, in credit unions about 13% compound annual growth rates over these couple of years. So really extraordinary levels. Move on to the next slide. Let's contextualize that with deposit history. What have deposits done for the past 50 years or so? 48 years, I think, technically, is what's on this slide. The long run average has been about 6.7%. So for the most part, folks have been able to wake up and get mid to higher single digit deposit growth in that times. And what really stands out, of course, is this experience in recent years, peaking at 21% in 2020, going down to still above 10% in 2021. In recent times, however, that has really reversed, and you see how steep up and steep down that deposit change has really occurred. And if you look at the long run history here, it's really been, even though there's a lot of squiggles on this chart, it's been relatively stable. It's been in that 5 to 10% range most of the time. Below 3 or 2.5% has been really unusual. A brief period in the early 90s, mid 90s, and back in 2018, 2019, there was a little bit of time with Fed tightening that had some lower levels of deposit growth, but been pretty stable at those levels. Well, where does deposit growth come from, right? So it's kind of curious to me, I've talked about this with Andrew a number of times, it's kind of curious to me that within our industry, we don't necessarily focus on what are the engines that actually drive the balance sheet. And I would argue that that core deposit growth is the real key engine that's driving depository balance sheets, but we don't talk about exactly where does it come from. And what I'd identify here are there are really 4 major sources of where deposits growth comes from. One is monetary policy. I think we've certainly seen that in the past couple of years, and I think that that's clearly the biggest driver for the behaviors we've seen in these couple of years. It's Federal Reserve action in terms of interest rate setting and in terms of quantitative easing or quantitative tightening. Secondarily, fiscal policy. There was a range of extraordinary programs that happened in recent years with stimulation checks, PPP program, extended unemployment. That all really immediately created bank deposit growth. It's a core engine of economic performance. If we think about depository ROE being about 10% historically and a 20% dividend payout ratio, you got 10% sort of organic funding growing through earnings, 2 percentage points of which get paid out in dividends, 1 percentage point of which ends up in investments. That leaves about 7% that goes into loans, which turn into deposits because as loans are credited to clients, they are credited as deposits. And so I think that's actually the core engine of what's happening with deposit growth historically, and then it gets affected by these monetary and fiscal factors. And then finally, client demand. We've seen, if you take a look at personal savings rates, famously in April 2020, it was 35% or so. Now we're back down to 5%. We're actually back down to personal savings rates at nearing historic lows as more and more individuals draw down from their accounts in order to fund inflation. So if we think about what's happening with these 4 factors right now, there's aggressively higher rates of quantitative tightening. Fiscal policy is no longer our friend in terms of generating deposits. All these programs have kind of come to an end. Economic performance, I think a lot of folks are concerned about the change in the credit cycle. Client demand, people are starting to draw down and savings rates are lower. So where is deposit growth going to come from? And what I'd argue is that it's going to be really difficult to generate deposits in coming months, precisely because all these factors that really are the engine of deposit growth are not really working for the sake of growing deposits. And deposits are likely to be more of a takeaway game than something that's going to be organic growth over time. Here's a look at the slide. Here's a look at the experience of deposit growth over just the past year. So this is September 1, basically, to the most recent observation, or 2 observations ago in early September of this year. Deposits for about 6 months, right until the Federal Reserve started raising rates and beginning some level of quantitative tightening. Deposits were growing at a 7.5% annualized clip. This is for bank deposits. It's what's available on a weekly basis from the Fed site. Since that time, though, it's actually outright reversed. And it's now about -1%, -2% on an annualized basis in the past 6 months. And you can see right when the Fed hiked, that's exactly when deposit growth really stopped. This is, again, this chart is taking a look at the rolling average, just because there's a little bit of noise sometimes week to week, but this just shows you the trend that since the Fed started actions, deposit growth has just stopped on a dime and actually started to go downhill. Loan growth hasn't stopped, though. Loan growth has continued. And as folks have spent down their cash on loans primarily in recent times, you see that the difference between deposit growth minus loan growth, peaked early this year from an index of last summer of 400 billion. Now it's gone down 900 billion to -500 billion over the course of the last 7 or 8 months or so, just showing that loans have continued. Folks have been fortunate enough to have plenty of funding sources and funded loans, but the deposits have stopped. And I think more and more people are just starting to wake up to the fact that the deposit growth engine is in reverse at this point. It's also reflected in cash levels. Here's a quick histogram of what member institutions have for cash levels here. These numbers were about 15% as about 2 years ago at the peak. Right now, the center of gravity is back to the low single digits for cash levels. There is still a tail of members who have very significant cash positions, 10% or more, about 20-25% of folks still have those very significant cash positions. But I suspect once we get the Q3 numbers, we're going to see this whole chart shift to the left even more, where more and more institutions have lower and lower levels of cash. So as deposit growth sort of stalls and outright reverses, is there some way in which we could actually assess the value of deposits? Is there some framework we can establish to actually quantify the value of deposits? And what I want to introduce here is just such a framework where we actually start to put numbers around what are deposits worth. And so this framework basically says there's 2 main attributes that we can start to bucket deposits by. One is price sensitivity and one is volatility. And that is to say that deposits that are less price sensitive have longer lives and probably longer term value. And deposits that are more price sensitive and have shorter term lives probably have some less value. But we all know that within products and across products, they have different lives, they have different sensitivities, different characteristics. How can we put this together? Well, there's a hidden relationship within the ALM metrics that we all already have, that we're using for NII modeling, that we're using for economic value modeling, that allows us to figure out the value of deposits. And what I'd say is we can identify 3 major buckets. One bucket that's not very price sensitive, not at all price sensitive, and has a very long life and low volatility. One that's just the polar opposite, that has a lot of sensitivity and a very short-term life. And one that is sort of in the middle. These are balances that are price sensitive but not very volatile. That is to say, if we pay those deposits, they'll stick around, but we have to pay them within a time frame. And so if we construct these 3 buckets through looking at the betas and looking at the decay rates that we already have in our ALM modeling, we can start to put some math around what are these things worth. So that very insensitive and stable source of funding, I'm calling core fixed here. And we can identify that as 100% minus the beta. That is to say, the beta has this hidden relationship where whatever the beta level is shows us how much are sensitive and how much are insensitive. If we have a 50% beta, 50% of our balances mathematically are not price sensitive, and 50% are fully price sensitive. We can use that to find these buckets. So in this example, at a 50% beta, 50% are core fixed, they're not price sensitive. 10% in this example of decay rate, having a 10% decay rate, are fully sensitive, because that's basically the balances we're saying are in flux that could leave within a shorter horizon. And then the rest is this core float. They're core balances, but we're going to have to pay them. And then how do we assign terms to each of these buckets? Well, the core fixed bucket, the insensitive bucket, gets a very long life. It's the average life of those deposits. The short bucket gets an overnight life, because those are balances that are done here and gone. And then the third in-between bucket gets assigned a term of the lag term. That is to say, how long, over what horizon are we going to reprice those buckets? We've seen right now, deposits. I think the big thing within the industry right now is recognizing that rates have moved a lot, but deposit pricing has not moved. I think we're starting to see that right now. A lot of places are really starting to raise rates more aggressively, but they have a lag term associated with it, and that's how we can figure out this in-between bucket, this core float bucket. Let's compare different product types using some of these metrics to actually put the numbers around it. So in the first example, we have transaction accounts that are assumed to have a 20% beta and a 30 basis point cost. If we use that framework that I just introduced very quickly there, we see in the middle part of this chart, the buckets, the core fixed float, non-core float. Because it's got a 20% beta, that means 80% of it is fixed. That is to say 80% of it is not price sensitive. The 20% is. We're saying that it has an 8% decay rate, so that's the core float piece, and then the rest is the 12% non-core float. We assign it the term values associated with each one of those. We add a liquidity premium to recognize the fact that our deposits have value different from wholesale funding. And the liquidity premium associated with the core pieces is the life, and the liquidity premium associated with the very short-term piece is just the year, because that's the balances that are expected to leave within a year. If we basically multiply the allocations by the sum of the value and liquidity premium, we add all that up, we get the headline valuation. For a transaction account, it's 4.3, 4.29. Put in fees and costs, and we get to 3.89%. If we do the same math for savings and MMDA and assume a 1% rate and a much higher beta, 60% beta, we get a gross profitability on this product of 3.18 and a net profitability of just over 3%, which makes sense, right? The first bucket, the transaction account, has more value in the long run. The second piece has less value, but still very significant value. Now let's take a look at the last bucket, a high cost special. If we have something with a very high beta, 95%, and a very high rate, 2.75%, the gross profitability is a lot lower, which makes sense because it's only getting a short-term life, it's only getting these short-term values, and the cost is so expensive. That ends up with a net profitability of only 65 basis points. And if we just want to take a quick look at what we did from a year ago, if you'd used the same methodology from a year ago, you'd have gotten much, much lower rates. Deposit rates around 1%. And a high cost special would have had almost no value because rates were so darn low at the zero bound. I do want to highlight one other thing here, which is that if you were to use this framework for FP&A analysis historically, instead of just using the swap rate on the term, you might want to use the rolling average of the equivalent swap rate for that term to kind of smooth out some of the volatility and to reflect the fact that you're looking at historical values, not prospective values. All right. How do we use this? How do we use this framework, this kind of more esoteric theoretical framework? Well, we can use it to start to think about deposit pricing exceptions and the introduction of new products. So the risk with new deposits, of course, is the big risk is cannibalization. But the benefits are you get to retain client relationships and you get pricing discretion over your deposits. And then we come to this kind of final way to put all this in one overall framework as we assess different funding decisions. So here we have a totally theoretical depository that has these 5 deposit types: transaction accounts, savings and MMDAs, and a potential high cost special introduced with the terms that we talked about before. Those are the profitability, net of all the costs and fees and whatnot that show it. And then we put in these starting mix. 40% is in the transaction accounts, 60% is in the savings and money market accounts. And what this framework is trying to assess is, if the erosion that could occur in deposit profitability from potential cannibalization exceeds the cost of borrowing, then you should just borrow. If we're going to lose so much profitability because of introducing a high cost special or giving out variances, it may make sense, especially in an environment where deposits are going to be scarce for everybody. No matter what we do, probably deposits are going to be flat to down for the foreseeable future, at least for coming months. Then it may make sense to just borrow. It may make sense to just think about wholesale alternatives. And so in the starting mix, if you could raise deposits at 275, you should do it if there's no cannibalization. If there's no cannibalization, that's going to be cheaper than other alternatives. However, if we remix just a little bit, if we have some of those existing deposits that go from the more profitable products into the less profitable high-cost product, we're going to start to see that it probably makes more sense to just borrow. In the first scenario, one mix there, what if only 5% of money markets went into the high-cost product? You should still do the high-cost product because that's not enough cannibalization to worry about. But once you start getting anything much above that, you'll see that the profitability erosion is more than the marginal cost of borrowing the FHLB. And what that comes back to is it probably just makes sense to borrow. So, we have tools available. Andrew was talking about the carry trade opportunity that exists on some of these short-term advances. We have a tool available for that as well. But I think this framework to think about deposit profitability can be very powerful for folks in a variety of contexts. But in this context around funding decisions in coming months, as deposits in the industry are likely to be very scarce, can help you really evaluate what the real value in introducing specials is, and when you might be able to just say, it might make sense to just look to borrowings instead of to trying to find extraordinarily high cost money. Turn this back over to Andrew to talk about NEV.
Well, thank you, Sean. Certainly all of our credit unions are well aware of the NEV test. But for those who may not be familiar, it's essentially the EVE measure of interest rate risk. And as you can see here, investments and loans are treated in very straightforward ways, where in the base case, things are marked to market. And then in the shock scenarios, they're based off of the actual characteristics. But the NEV framework applies standardized premiums to the deposit side of the balance sheet, which are most likely very different from what you're experiencing in your ALM inputs or your deposit studies that imply much more average life in these portfolios. As Sean alluded to, the different rate environment, as we all know, that low-cost deposits are gold in this environment where rates are now higher. So the net effect is it makes everyone appear to be more liability sensitive than maybe their ALM modeling would suggest. So, this has been around for a number of years, and in the last year or two, it's gone from maybe nuisance to actual problem. And the reasons for that, it's been kind of the perfect storm in terms of the market environment. So capital ratios were stressed because of the historic growth that Sean started the presentation off with. We've called that in the past reluctant leverage, where you've grown just because you were open and deposits came flooding out of the sky. Yeah. The second part of the equation was, with all that excess liquidity, many folks extended out the curve at low rates on the asset side of the balance sheet. Then in 2022, as we all know, rates have moved higher, and that has stressed the fair values for those fixed rate long assets. But because of the standardized deposit premiums, there hasn't been that offsetting differential where what happens with the deposits balances out what is happening on the asset side. So earlier this month, the NCUA did make an update to the framework, and the key things there were removing the extreme risk category, which many members had moved from moderate risk to high and into extreme. And they also have given field examiners a little more leeway in terms of assessing on a case-by-case basis. But you'll notice that they didn't address the crux of the issue, which was the deposit premium, the standardized deposit premium. So I think if you think about these updates to the framework, and we've confirmed this through many conversations, is that this was, by no means, a game changer in terms of, how to view this framework, and it's probably closer to status quo. So that being said, we have this interest rate risk on the books. What do we do? How can we handle it? So the first thing is to look to defend your position if you truly believe that you're positioned the way you want to be, and that's reflective of the risk and the return opportunities that you have. Defend, justify, explain, quantify. Managers know their balance sheets backwards and forwards. This is the time to be able to communicate that. Absent that, there's three main levers in terms of actual balance sheet decisions that could allow you to mitigate interest rate risk. So the first one being shrink the balance sheet. Same amount of capital supporting a smaller asset base, those ratios move higher. On the asset side of the balance sheet, you can shorten your assets. remixing the loan and the investment portfolios to be shorter in terms of interest rate risk. Now, you can see as we highlight there, good in theory, but it takes one of two things that are in short supply right now, time or adverse income statement impact. When we think about how much cash flow is running off of those fixed rate portfolios right now due to prepayments, it's not a big amount. And certainly to sell underwater investments or seasoned underwater loans, you'd be recognizing those losses through the income statement. So the third way to handle it on the balance sheet would be to extend the funding, which is what we're going to focus on here. So in terms of advanced solutions, there are three ways that we can think about extending funding. So the first thing that is evident in the three products that we're going to discuss today would be the point on the curve. Pretty straightforward. We want to have a fixed rate liability for a defined period of time that is going to be supportive of mitigating interest rate risk. Then the other two components being cash flow, being able to control the cash flow, and also mitigating cost. So those are two things that we all want to have at all times, but there's a little bit of a trade-off involved here, and we'll get into the trade-offs involved between being able to control the principal amount outstanding, but also being cognizant of what we're paying for our funding in a period of time where NIM has done well, but the music may be beginning to stop because of the deposit pricing things that Sean was talking about a little bit earlier. So let's talk about the long-term classic advance. And as we alluded to before, with markets whipping around, these rates were accurate at the time we pulled them, but the idea and the shape of the curve still continue to hold true. So why does a long-term classic advance help in terms of mitigating the results of the NEV test? So it comes down to the standardized premiums and how things are treated in the rate shock scenario. So if you look at the bar chart on the right, remember that the standardized premium in a shock scenario for a non-maturity deposit is 4%. So that implies a price of 96. And because we're talking about liabilities, a price below par is a very good thing. So a 5-year classic advance in the base case at par in a shock scenario is priced 87 cents on the dollar. So if we were to make an assumption that you would take advances at 3% of assets, a number that many of our members are at, the differential in terms of the contribution to the capital ratio in the NEV test is about 0.25% when comparing that 5-year classic advance versus the standardized premium on the deposit. So that's a not insignificant amount. Certainly, if you're right on the cusp of one of those lines where maybe this pushes you from the high bucket to the moderate risk bucket. The second advance is the member option advance, a well-named advance, which predates both of us. So whoever named that, we'll give them credit. Maybe we'll give the credit to Dan Redmond. Everybody loves Dan. So way to go. So as the name implies, it's long funding, but the member has the option to shorten the advance if it's to their economic benefit, and we'll get into that in a second. So on the left-hand side, you can see a strip of classic advances, and on the right-hand side, some member option structures. So all the way to the right, you see a 10-year maturity with a one-time call option at the 2-year mark. And you can see that the rates are higher on the member options versus the classic. That makes sense. That's intuitive. That for that flexibility, that those differentials, that's essentially the option cost. Now, why does this make sense and why does this support the NEV? You can see along the right-hand side. For the purposes of the test, you get the benefit of that 10-year final, which has a significant amount of duration in it, such that in the shock scenario, it's priced at 80 cents on the dollar, where compared to that 2-year classic advance, it's only 94 cents. And we do that same exercise that we did on the prior slide, and we're getting closer to about a half a point of capital ratio support in the NEV test. So some quick scenario analysis on, okay, so how would I think about using this advance if rates go down or rates go up? And it's pretty straightforward in the down case where, you fund long and then rates go down and you say, well, why did I fund long? Because the NEV results are going to get better because your asset values are going to be in a better position. But also, like we talked about before, you have now the benefit of time. How much cash flow can run off your investment portfolio in 2 years' time to allow you to recalibrate where you need to be on investments to assets or even your capital ratio. So certainly in a down rate environment, you are absolutely going to want to exercise that call and refinance, much like mortgage customers would do, into a lower rate liability. You may not even need the liability because you may, at that point, may not be in a position to need the same amount of wholesale funding. What's interesting is that even in the uprate scenario, there can be benefits, and you can even still have the ability to refinance lower in a rising rate environment. Sounds counterintuitive. The reason being is depending on the magnitude of that move, if the funding rate, if market rates at that point are below the 540 that you could have paid today, even where rates may be at that particular time, if they're below 540 at any point on the curve that is where you would like to be, then it's going to be economic for you to exercise that call and refinance. So flipping around in the mirror, the HLB option, different than the member option, is where you grant the Home Loan Bank Boston the ability to put the advance at defined intervals. And for giving up some of that control over the timing, like we have in the member option advance, there's the benefits to the cost that we're going to have. So here we can see an example of the classic curve in green and two indicative structures for the HLB option. And we can see along the bottom, that structure is a 10-year final maturity with a 1-year lockout period. So it's fixed and can't go away for 1 year. But then once you hit that 1-year mark, it's dependent on market conditions at that time. It may be put back at that point, and then every quarter thereafter if it's not put. So now compare that 1-year rate, compare that to the 1-year classic rate at 451 versus the 294. So you're receiving over 150 basis points of compensation for taking that risk, or the potential that it may not be definitively a 1-year advance. So this is a function of volatility, and Sean's going to get into volatility and options a little bit later. But it's pretty incredible that right now we are seeing market volatility much, much higher and comparable to where things were in March of 2020. And we all remember how unique of a time period that was. The other structure there is different, but similar in terms of it being a shorter maturity, longer lockout, less frequent call options. It's just a one-time option. But you can see that there still are cost savings compared to both the 2-year period where it's the lockout period or the potential final maturity of the 5-year. So let's talk about preparing the balance sheet for lower rates. So as we were talking about, ideas to talk about, we got some quizzical looks from some of our colleagues saying, wait a second, every day rates go higher. Every Fed meeting, they're raising it 75 basis points. And you want to talk about lower rates. So we felt like this guy over here tuning up his snowblower on a beautiful beach day. But I think this is balance sheet management 101, right? We have to be looking forward and not in the rearview mirror. And we're going to get into why we should have the prospect of lower rates on the horizon. So the Taylor rule is a metric that the Federal Reserve has used historically to look at a number of different indicators and tell us where Fed fund rates should be. So right now, according to the inputs, Fed funds should be somewhere between 6 and 9%. So we've already seen a pretty incredible move, and we'll see in a slide or two that there's more projected on the horizon. but it really tells us how unprecedented waters we are in, considering that we all associate being in a recession with lower rates. We're technically in a recession right now, and rates are continuing to rise, both the long end of the yield curve, which the Fed doesn't control as much, but also the Fed's indications about what they're going to do on the front end of the curve. And the reason why we have this, these competing forces is because it's really all about inflation. And this is mission one for the Federal Reserve. So along the right-hand side, you can see some of the quotes from Chair Powell's recent press conference. And, he talked about pain a little too much for my liking, in terms of what may happen to the economy and the markets as a function of continued rate hikes. So they're playing an interesting game, trying to snuff out inflation, and seeing the volatility and the hiccups in the equity markets and the credit markets. So one thing when looking at the dot plot from last week, as well as the 3 months and the 6 months before that, we can see at present that the near-term expectations continue to go up, but the longer-term expectations aren't budging too terribly much. So that makes the prospect of there's a lot of talk about the soft landing versus the hard landing, that much more challenging when there's the expectation that as fast as rates went up, they'll come down just as fast. So, we'll get into, what's on the table in graphical form on the next slide. But really, when we think about actual balance sheet decisions that depositories can make, it comes down to what is our opinion on the tenor of the pause at the top and how quickly the pivot to falling rates are going to be. And just generally speaking, and Sean's going to go into some more actionable ideas in a few, if we're of the mind that it's going to be a very brief pause and a quick pivot down to lower rates, then concepts like asset duration and positive convexity, prepayment protection, flexibility on the funding side, those are the types of things that are going to likely outperform in that type of environment. If we see a period where rates continue to rise and they pause at the top and rates aren't as they don't come down as fast as they rose, then being underweight duration and instruments that have negative convexity and the ability to earn added carry and income along the way, those are the things that have a greater probability of serving you well. So when we think about the historical length of the cycles, we put this together to show, going back over a couple decades, that the cuts and the hikes and the pauses aren't very long, tend to be between 7 and 13 months. Yeah. And the cuts tend to happen faster than the hiking cycle. So when you think about 7 to 13 months, we're not talking 7 to 13 weeks by any stretch of the imagination. Depending on where the calendar falls, it may be, you get a whole year of that pause cycle. So, there's a balance to be had between, what are going to be the practical implications for the balance sheet decisions.
Yeah, I think I just add to that. If we think about that prior slide about how quick those pauses are, it's almost necessarily the case that they're quicker. I think because the higher rates and the tighter conditions help predicate the next slowdown. So it's almost as though it sort of feeds on itself, and then the troughs tend to be a little bit longer. So we've seen a very, very extraordinarily quick change this time, but that's very unusual. Andrew talked a lot about options, and I just want to take a moment to kind of demystify a little bit about options pricing. There are components that go into options pricing that can be identified and that themselves can be quantified. And here we show those different components. Really, the two big components that go into anything are highlighted in blue here. It's the time and frequency of the options that are offered or taken, and it's the implied volatility. And implied volatility is basically the recognition that there's uncertainty about what could happen over time. As Andrew alluded to, implied volatility over the past year has more than doubled in interest rate space. And so the implied volatility levels we're seeing right now are really extraordinary and have only been observed a couple times within our careers. So the implied vol is very, very high, which means that there might be opportunity in some of the options products that we offer. And something else I want to highlight here is that, besides demystifying the components of volatility, banks and credit unions, assume options risk all the time. Balance sheet managers are in the position of managing option risk literally all the time through mortgage-backed securities and callable bonds, through mortgages themselves, through loan prepayment risk, and through managing non-maturity deposits. So, there's nothing super unusual about taking options within wholesale funding sources because we're kind of doing it all over the place all the time. And a final piece that I highlight on the last bullet here is to say that, booking a mortgage at 6-7%, maybe even at this point, 6-something%.
Has it gone to 8% since we've been here?
Yeah, it might have. I didn't get to check the markets this morning because we were setting up. If we're highlighting a mortgage that's at a higher level, it's the same type of risk as an HLB option. That is to say, if you like booking a mortgage today in the sixes, it's the same math on the HLB option. The big difference is that on the mortgage, if rates come down, you'll lose the asset and lose the income, and the liability will stick around. You'd still have the liability to pay it. But it's the same sort of risk. It's just sort of a mirror image on a different size of the balance sheet.
Right.
One is lost income, one is extra expense, but it's the same risk. So if you're worried about an HLB option, it's the same thing on the mortgage side. And here's to take a quick look at investments versus loans. And the reason I really want to highlight this is right now, I think a lot of voices are out there saying that investments present opportunities that we haven't seen in a very long time. And one of the risks that depositories probably don't quantify as rigorously as could be done is this option cost associated with prepayment risk in lending products. So here I just laid out a couple different opportunities. What if you had a muni, a CMBS, and a loan, all at 7 years? And this option cost, again, can be quantified from those components that we talked about earlier. But a year ago on the lending side, the option cost on a loan without any prepayment structure would have been about 28 basis points. Today, that's 80 odd basis points. I bet it's closer to 90 right now, actually, after the last couple of days, in terms of the actual option cost. And that has very dramatic effects on the net spread that a depository is going to realize on their asset base. So, as you think about different balance sheet alternatives, especially in context with flat and probably lower deposit rates, being more judicious about the risks that are assumed and the pricing that everyone's getting for those risks is probably wise. I think you might find that things with positive convexity that Andrew was talking about, that is to say things that when rates reprice down will stick around because we have good prepayment penalties in there, or because they're bonds that have that embedded in them, are going to really seriously outperform. And again, just to throw some numbers around this, I showed this last time, but it really helps highlight this. What if we had a $5 million deal for 7 years and put in a step-down structure, 5, 4, 3, 2, 1, 5%, 4%, et cetera, down to zero in the last couple of years. A few years into it, rates are down 200 basis points, which isn't even anywhere near as much as could occur given where nominal rates are right now. Well, the economic loss on that is about 5.7%. But the depository would book a $100,000 prepayment fee and say, look at us, hooray, we got this prepayment fee of 2%, that's $100,000. Economically, though, they lost 384, so, or I should say, the 384 is the value that they actually lost. And then, so the difference, the economic loss between those two values is $284,000. But it doesn't show up in an accounting statement anywhere. It's kind of invisible to people. But those are real dollars that are a big opportunity cost that, if you don't have good, rigorous prepayment structures, may mean in this environment with funding scarce, with rates up so much, with so much potential risk to the downside someday, may not be as marginally worth it. And then here we look at different strategies about thinking about funding sources from us, from different advanced products, versus different assets that could be selected. And we go from sort of the highest spread to sort of the lowest sort of spread. And at the top end, is taking buying MBS funded by the HLB option. Again, I said those are sort of mirror images of each other. But what that means is you're doubling down on risk, but you're getting paid in the meantime. And so if rates were to stay right where they are and behave, you would garner this 2.24% spread because the asset would stick around, the advance would be called, and you just refund it at the same price, and you continue to maintain that spread if rates stick around here. So you get paid very, very handsomely on the spread between those two things. And the risk, of course, is that if rates do pause, you get a double whammy. The asset goes away, the liability sticks around, and you'll be upside down in a hurry. So think about what type of overall risk could be assumed in a trade that we're thinking about here as funding wholesale with assets. On the other end of the spectrum, if we think about funding a 7-year MBS, we're just short funding it with a 2-year classic, there's not a whole lot of spread right there, 24 basis points. Not a huge number, and it might be higher right now actually, but not a huge amount of spread. But if rates reverse, the 7-year will stick around because those CMBS have rigorous prepays in them generally. And the classic would reprice a lot lower really quickly after the 2 years. And so that spread could widen out more than 200 in the first example.
A lot.
Yeah, it could widen out 400. So there are different structures that will complement whatever your risks are. If you're concerned about down rate risk, and I suspect more and more depositories are going to be concerned because their modeling is going to show that they can't cut liability pricing from near lows with higher rates, you might want to think about bullet structures funded by other bullets. Or if you're comfortable with rates being up here, you might think about opposite kind of structures. I think for a lot of folks, we just want to highlight that here at the FHLB, we don't just offer fixed rate advances. There's also floating rate advances, and they're not necessarily put out on the rate sheet every day, but they're certainly something that the desk can assist in identifying for you on the pricing. But if you're a very asset-sensitive bank, and a lot of folks are asset-sensitive, if there is a quick pivot, the floating rate will adjust automatically with you. You're not going to have to worry about the tenor associated with the advance, that structure, and hoping that rates come down and enhance your profitability. The advance will reprice right along with the rest of your profile appropriately. So you don't have to assume any of those risks. And so again, depending upon every depository's profile, and everybody is different, different funding solutions against different assets are going to be more or less profitable depending upon the environment. For a lot of folks, floating rate advances might be a good idea right now because it will allow them to reprice down once this environment has kind of calmed down. And the fixed rate advances already are pricing in the future hikes. I think folks understand that, but when you look out on the curve, it's already pricing in the fact that Fed funds are going to upper 4s, maybe even 5 in coming months. So the short rates will catch up to that, but it's already baked into the fixed rate pricing in the first place.
So that brings us to the end. Thank you, everyone, for joining us today. Hopefully, you got something out of this, even if you weren't looking for the exact date when the pause and the pivot will occur. Yeah, but we can tackle that as it comes. But yes, thank you again for your time. We appreciate you tuning in, and we have a number of things on our website that hopefully can be of value to you in terms of the strategies and the things that we talk about. And if there's anything that we can do or be of assistance with, please feel free to reach out to us or your relationship manager, and we will do what we can. So thank you again, everyone, and have a great rest of your day.
Thank you.